All right, let's get a move on then and put the spotlight then on talking about what the outlook is when it comes to the Big Bang merger as well as what the implications are down the line. We've got Abizer Diwanji, who is the head financial services EY, as well as Digant Haria, co-founder at GreeneEge Wealth, joining in on the show. Just wanted to get in a sense from you then, Abizer, first as to what exactly would be your outlook on the fact that now you've got the merger dates that seem to be out. Do you think that the overhang on the stocks are going to go away? What is your outlook in terms of the returns potentially for the long haul?
Oh, yeah. Thank you. Thank you for adding the word for the long haul, because I'm not a stock market player, so I won't tell you the immediate hang on. But for sure, as everybody else has said, this merger makes imminent sense for the simple reason that you're trying to create a large organization which has many synergies. So, and that synergies will clearly result in larger value, as Mr. Keki Mistry himself has said, that only 2% of the bank's customers actually avail of HDFC loans, and at 5% of HDFC's customers avail from loan from other banks. So at the end of the day, the potential of the 90%, and even if not all of the 90%, a substantial portion of the 90% coming into the mortgage market of the merged entity, which will be competitive in terms of pricing, is amazing. And at the moment also the company's total assets under management are 22 lakh crores. It's amazing. SBI is at 32 lakh crores, and ICICI becomes a far distinct at 10 lakh crores. So ideally what will happen is that the process of consolidation has now jumped onto the private sector. After many years, when PSU and so we had 3 banks consolidate PSU banks, and now we're having the big major consolidation happening at the HDFC level. So is it beneficial for the long-term stock in terms of its growth? Absolutely. Will it create more enterprise value going? Absolutely. However, we are all skeptics, and we have to be cognizant of what are the risk factors. In my view, the single largest risk factor that it faces is rebalancing its own balance sheet. It's got to meet 80,000 crores of SLR requirements. Where will that money come from? ICICI Bank, years back, when they did not get the SLR requirement, had to borrow long-term costly funds. And by the way, at that time, the interest rate market was a falling interest rate, low interest rate market. Now we are on a high interest rate market. It becomes much more difficult to actually raise money and sustain those kind of balance sheets given the high cost of SLR borrowings. That's one. Second is the overcrowding of the PSL market. They've got to meet 90,000 crores. Yes, they've got time, but they've got to meet 90,000 crores of PSL demand on the merged entity, priority sector lending. And the priority sector is generally starved of funds. And if they end up getting such large funds, either through the PSL certificate route or the NABARD route or through the direct lending route, it's likely to create bubbles. And those bubbles could result in NPLs. So ideally, how best the bank will manage that PSL is going to be extremely, extremely critical. I'm not at all skeptical that HDFC will be able to manage it. I'm sure they will be able to, but bubbles get created in the markets. Third issue from a stock market perspective, very clearly, is the 10% cap issue and where the rebalancing of portfolios and mutual funds will happen. We will see a short-term dip in the share price for the long enterprises maintained. I'll stop there.
Digant, good morning. I was reading one of the most fantastic books, and this book is again from Pulak Prasad. It must have reached your desk also. And there is a chapter which is dedicated to M&A in that. And it says that 9 out of 10 M&As actually have failed. I don't want this M&A to fail, Digant. But history says that 9 out of 10 M&As have failed. It's a very simple data point which Pulak has put out. I don't want the M&A to fail. Trust me, no, I'm not saying it will fail. But that's the data. It's a KPMG data. Sorry, it's not a ENY data, but it's an KPMG data.
I think when Pulak Prasad says that 9 out of 10 M&As fail, I think he is referring to failing versus the expectations of synergies that we have from the merger. So I think in the first place we aren't expecting much synergies from the HDFC Limited HDFC Bank merger. When this merger happened, we discussed that this is more like a forced merger, that HDFC Limited had become so large for being a standalone housing finance company that it needs to get into the bank. I think they delayed the merger as long as they can, because HDFC Bank never wanted to have a low ROA business of housing finance on their balance sheets. I think this is not a merger of synergies. It is a merger of, merger with no choice. That is how we should look at it. See, markets also, you look at it, it's 1 year since the merger was announced in August. And, the stocks have practically gone nowhere. There is a lot of nervousness that whether, such a large entity, a 22 lakh crore entity, will it see an ROA dilution or an ROA accretion? I think the street is still confused. I also don't have a very clear view as of today because, see, HDFC Bank itself is going through a leadership transition, and now you have to have this merger together. So I think it definitely is not like a one side answer for me that this is going to be a super successful merger or it will create a synergy. I think it's something which had to be done. Glad that it is done. Now the question is that if there are synergies, HDFC Bank can be a 24,000-2,500 rupee stocks. If there are no synergies or low synergies, this will be a 1,900-2,000 rupee stock, say a year and a half from now. I think that's a bigger question that we keep on debating.
Abizer, my next question is that the three factors which you outlined, one more factor which Digant just talked about is that there is a change of guard there after Mr. Puri's exit, and there would be an amalgamation with the new team when Deepak Parekh and KK Mistry would be stepping down. So we are looking at a merger happening at a time when the old guard genuinely is making space for the new guard. And it's always complicated when you've got so many exits and then a big merger. Abizer, the question was for you. I think my audio is not good.
Sorry, it's for me?
Yes.
Sure. No, so I do agree that there has been a leadership transition, and sometimes leadership transition is good. So first time I would kind of say that Pulak's data is not 100% valid here because this is a merged entity of two entities which already had synergies. HDFC Bank and HDFC Limited were working in tandem forever. Yes, newer cultures will come in and newer people will come in, and those will have to be adjusted and scale will have to be managed. I don't deny that. So are there risks? Clearly there are risks. But if you come to the leadership changes, I think that we have had now 1 year of leadership change that's already happened at the HDFC Bank level. And we've seen that change bottom of us into many things, right? We've had a technical hitch-up, a technology hitch-up in the past. The operations were suspended for some time because of technology issues. We've also had newer people come take charge of newer things, and that is kind of done. The only big portion that they have to deal with in two things on leadership, and in a way, it's good that the leadership is changing at the HDFC Limited. One is the overhang of an MBFC mindset has to go away. So what we'll be left with is middle-level managers at HDFC Limited who are focused only on selling mortgages. And mortgage is still a massive market. As I said, that it's 2% market share today that HDFC Limited has. It can go up to 5% if they get every other bank share. That is tripling of size. If that actually happens, they will need somebody to clearly focus on the asset side of the mortgage business, and which is what HDFC is very good at doing. What they are not good at doing, and where synergies and leadership changes will need to happen, is how do you harness the liability side, which has always been a problem for an NBFC. So I do think that this was a merger in the happening for the last 10 years. So we have seen a lot of changes, synergies, planning that has happened. Like I'll tell you structurally on the balance sheet, HDFC raised the largest bond issue in 2002 to refinance all its bank liabilities. They did not have to wait for a desperation till a merger happened. So I think this merger has been in the making for the last 10 years. Possibly personalities did not make it happen, but it is now happening. Size has been an issue, as was rightly been pointed out. So now we are actually in the midst of a transition process which has been on for a long time. So I think the disruptions will be minimal, but to mind, there are disruptions that can happen.
Digant, now let's understand for the minority shareholder, in this entire sequence when the merger will go through, what should they expect?
See, for a minority shareholder, as I said, the question is that, do the profitability, what will be the growth and the profitability of the merged entity? Growth, we don't have much doubts that, see, before the merger, HDFC Bank grew at a 20% CAGR, HDFC Limited grew at a 16% CAGR. Maybe the combined entity grows at 18-19% CAGR. that doubts are not very high. The thing which really decides where the multiples of the stock will trade at will probably be on the profitability part. Like HDFC Bank, X of the HDFC Limited business could have easily been a 2.2% ROA kind of a bank. Now with the HDFC Limited merger, the debate is that it will start its life with say 1.7, 1.8% kind of an ROA, and eventually move to 2.1, which HDFC Bank has delivered. And the journey from this 1.7, 1.8 to 2.0 will actually depend on how well they can get the RBI dispensation on liabilities, because as my other colleague pointed out on your show, that there's this SLR thing which has, and the PSL, these two norms we have to still that hurdle has to be crossed. And second is that if the mortgage cross selling really happens through the large HDFC Bank branch network, then we may get some more cost synergies, and that is how you go from 1.7, 1.8% ROA to the 2% ROA. And that, I think, at that ROA, which could probably be 2 years away, I think the minority investors can think of some re-rating also in the stock, along with earnings growth. I think for minority shareholders, the question is, whether it's a 2,000 rupee stock or a 2,500 rupee stock in the next 2 years. But there is definitely, we are all thinking in terms of upside, whether that upside is $300 from here or $600 from here. That's the question. So I think minority shareholders can be relaxed that after 3 bad years of, 3 years of no performance, they can actually look forward to at least some performance, because the merger overhang will go away in a month or two from here now.
I'm going to break this for our viewers, and this is something which we at ET Now feel is going to be working for them. You look at HDFC Bank, they are market leader pretty much, or they have 20% market share in all the major categories: home loan, car loan, their market share, the corporate deposit, the credit growth. But they don't have large presence in the home loan market. They don't have large presence in the home loan market. Why? Because they were distributing the loan for HDFC Limited. Looking at the way how real estate sector is growing, well, I mean, if the bank has to double its book in 3 years or 3.5 years or 4 years, at a multiplier to India's GDP, they will have to have a sizable presence in the home loan market. HDFC Limited has not gone outside 500 cities because they cannot manage that kind of a book with that kind of a low NPA. HDFC Bank has a strong presence. In order for HDFC Bank to grow, they need a lot of liabilities. Liability is the deposit which you and me put in. And that liability will only grow if they are getting access to low-cost deposits and they are able to service a lot of home loan bank accounts. There are a lot of accounts which HDFC Bank has right now where the loan is actually coming from an ICICI Bank and SBI, and which the bank is servicing. As a result, they lose a lot on CASA. So that also really would be beneficial here. Now, Abizer, just to get very, some clarity on small issues. What happens to current HDFC Limited depositors? Do you think their deposits could be repriced? Do you think they would be given an option to cancel it out, or it would be repriced at the lower rate because HDFC Bank deposits would be at a lower rate now?
So one is that I don't think contractually they can reprice those liabilities. I think that if there is a contractual liability that HDFC has agreed to its own deposit holders, retail deposit holders, that has to continue at the same rate. This will be like bulk deposits sitting in the balance sheet of a bank, similar. So they are differentially priced. They will be differentially priced. I think slowly and more steadily, as most other banks are doing and HDFC is also doing, is that trying to get more and more into the skin of the customer, and effectively will try and convert a lot of their existing depositors into CASA depositors. Now, when they convert into CASA depositors, nobody is stupid enough to say, let me break an FT and put it into CASA, because that's clearly not remunerative. Unless they try and offer him cross-sells and improve a overall return on customers, then the deposit rate that you're paying to the customer will become immaterial. But what's more important is to try and analyze and say, if this depositor has been with me for 5 to 7 years, he has surplus money to put into the company, what is his credit worthiness, and what as a bank I can cross-sell, which HDFC Limited could not. So a lot of it is going to be on customer mining, data management, dealing with the customer and maximizing revenue per customer and not restricting it only to a deposit rate.
And finally, what will happen to existing home loan borrowers HDFC Limited, will they have to get into any kind of a contractual agreement? What kind of tenure changes there? And will there be a different way in which how the future rates would be calculated for them? Because the CASA, the ALGO committee, everything changes here, right?
Yeah, so I think what happens there, Anuj, is very important. I think first of all, they would have done this customer segmentation. So how many of our customers are vulnerable to getting a refinance out of another bank? And wherever a customer is vulnerable to getting a refinancing out of another bank, should we leverage HDFC Bank's low cost of funds to reprice their loan? And that I think will happen. But there will be enough customers on the low-cost housing basis who are actually the targets of NBFC. Look at it. I mean, only 5% of the book is actually, funded to other banks. There is a massive loan market which is existing for the NBFC market. And that NBFC market loans, HDFC, the merged entity, would be sensible enough not to reprice because they don't need to. Because HDFC Limited will continue to enjoy the higher yields on those assets because that's how the loans have to be priced. Now, luckily enough, banks do realize that pricing is not just based on a cost of funds, it's also based on the cost of risk. And ideally, those customers who are vulnerable to a cost of risk are the ones who can easily get a refinancing from another bank. Mind you, the only issue here is that banks are getting very aggressive on the home loan market, other banks. And there is a possibility just to get customers out, banks may offer discounted rates. So at that rate, to retain the franchise, the merged entity may, at least the HDFC Limited customers, will have to make sure that they are, the bank will have to make sure that they are adequately priced so that they are not vulnerable to going away and getting refinanced.
All right, gentlemen, thank you very much. And you've been very accommodative with your time today. So thank you very much, Digant and Abizer. Markets, meanwhile, what do we have? Well,